A lot of folks are sending the all clear signal about what happened, seeing as how the markets have recovered the vast majority of what they lost during the Monday sell-off. Do you feel as comfortable with the way things are shaping up?
Hey, good morning, Dom. Yeah, not quite as comfortable. I'm not sure all clear is the right way to characterize what's going on right now. But at the same time, I don't think Monday's absolute panic that we saw was also the right way to characterize the global economy and sort of where markets are. Look, we've got a stock market that has the Fed put back, but also one that's clearly decelerating. And so balancing those two things is really the job of the job of market participants over these next couple months. And we will get some help from some data this week that we did not get last week.
Is there anything that can happen this week? Do you expect anything that could happen this week that would derail the market recovery that we've seen? Is the inflation data still that important to the overall market story?
The inflation data has definitely taken a back seat to employment data and to growth data. I mean, the market has moved on from inflation, frankly, as being a real thing. Now we're more worried about employment and growth, especially in the United States, than about inflation. But should we get a real surprise? I mean, like a 4/10 kind of one month over month number in CPI, that could derail things and really, frankly, just confuse people quite a bit. At the same time, we've got a deflationary number out of the inflation prints this week. That would also spook folks from the growth front. We don't really see a very high probability of either. But if we did see something like that, it would certainly rankle market participants.
A lot of opportunities were created during the market melees over the course of the last week. Are there now certain parts of the market, given the market action we've seen, that you prefer over others? What goes on the shopping list and what would you stay away from?
Yeah, look, I mean, I think tech has to be back on the shopping list. It has gotten throttled over the last several sessions, as we all know. But the medium-term story there is just too compelling. The AI story is too compelling. Where people are spending money, where this economy is going. This is a mid-90s kind of story still, and so the tech has to be on the shopping list. Additionally, things like energy and home builders. Energy gives you a little bit of a Middle East hedge, which is helpful in an upturning economy. And things like home builders are sort of first movers on rate reductions, and so they got hit pretty hard last week as well. Those are things that we like right now. The things that we generally don't like is anything tied to Chinese growth. So I think like metals and mining companies that really need Chinese growth to pick up for them to really do well, or any sort of deep value kind of names. So the junk of the small caps are deep value names, things that really need an accelerating kind of V-shaped economic trajectory to win. And we don't see that. We don't see a kind of a V-shaped or sharp upward trajectory in the economy. We don't see a recession either. But the sharper upwards thing, probably not.
But wait a second, Scott. So what then about this entire story, this narrative around the broadening of the market? Why we are seeing, at least over the medium term, relative outperformance in small caps? So that's all gone now. You're going right back to the muscle memory where we were, and that's mega cap technology, media, and telecom.
Well, look, I mean, I do think there are some cyclicals and there are some parts of the that trade that can still work. The broadening trade that can still work. We probably prefer to play it more inside of the SP 500. So so larger companies that, or even mid-cap companies that can still grow and keep up. We do think the broadening theme can be real. We think the market got a little bit ahead of itself. But anything junky, anything that's not making money, basically, we think is really going to be challenged here for the next 6 months at least.
And before we let you go, we've seen interest rates move decidedly towards the downside direction, expectations for slowing growth, perhaps expectations about future Fed policy. Where do you think interest rates need to be in order for the markets to feel like they can get back to a scenario where they can continue a medium to longer term move higher?
Yeah, look, if we're talking in terms of 10-year rates, probably anything between like 3.25 and 4.25 is really sort of the money zone for that. You get much below 3.25 or maybe even 3.5, and then, Dom, you really do open up the growth scares again. You get anything more, over about 4.5 or so, you're going to get some of the inflationary pressures again. And so we think right around where we think rates are basically priced right here. And so a big move in either direction we think is fairly unlikely. But like I said, anything as you approach the 3% bound or the 4.5% bound, you're going to have different sorts of worries and different sorts of wobbles. But we just don't think that's very likely right now.